Well, it's been challenging, Tom. This all began the weekend of February 28th, and there's been no place to hide. Gold is off $1,000 an ounce. Bonds are higher in yield, lower in price by, 30 to 50 basis points. And equities are off somewhat measurably. So there's been a very, I guess unless you were just sort of long the dollar and maybe you're triple levered cash, there's very, very difficult place to be right now.
What do you do with duration in the fixed income space and all your work at Citigroup over the years in RBC? I mean, duration's a tool, right? Explain that to people that don't get convexity.
Right. I mean, clearly, if you're of the view and you're long duration, you're for every basis point move in the bond market, as you move out the duration curve, as rates move lower, you're capturing oftentimes multiples of the upside relative to when rates move lower in the front end of the curve by about 4 or 5 times in 10s relative to 2s and about 10 times in 30s relative to 2s. So it can work in your favor, but in an environment like the one we've been in over the last month where rates have gone up, if you've been just long the long bond, you would have clearly underperformed relative to just being long, let's say, the 2-year or the 10-year. My view on duration at this point is really a question of where are we on inflation in the long run. If you look at 10-year break-evens, they're about 235 this morning. The 10-year is about 435. So, we have a month ago, break-evens were about 5 basis points lower. So really unchanged in terms of long-term inflation expectations.
Stocks, bonds, commodities, alternatives. What's your asset allocation look today versus maybe 4 or 5 weeks ago? Anything changed?
Not significantly. I would just highlight that we own all major asset classes across many of our client portfolios. Even, you mentioned alternatives. Alternatives, we try to own the areas within the alternative segment that are less correlated, negatively correlated, or non-correlated to long-only equities and long-only fixed income. And I think that's really, held in there quite well for us. We're not owning just, sort of long-only private equity, long-only private credit that's highly correlated to both equities and high yield in the public markets. That doesn't provide the diversification that we're looking for in alternatives. Within equities, clearly the value trade has been on its heels month to date. But if you look over the course of just year to date or even last year, still the value orientation has generally worked, both home and abroad. The Russell's still up fractionally on the year. Equal weight S&P's up fractionally on the year. The rest of the market in the U.S. is down on the year. Japan's up on the year. EM's up on the year. And that's a very value-oriented sector allocation there.
We saw in 2025, as well as the U.S. markets did, a lot of markets outside of the U.S. did even better, in part, maybe in large part, due to the weakening dollar in 2025. How do you think about U.S. versus rest of the world in 2026?
It's tricky. I think the real question is duration of this war in Iran and the degree to which that's going to potentially keep the dollar sort of buoyant relative to possible weakening if there's an off-ramp or if there's a cessation of things there.
How do you look at shocks? I just had an email come in. Thank you so much, folks, for all the information from listeners. And it's amazing what you can do with this AI. You can convert a liter per pound or pence into a U.S. gallon by just typing in a couple words.
Wow.
I had a Kufalesser slide rule trying to figure that out not too long ago. In London, $8.78 per gallon.
No, thank you.
In Hong Kong with Laura Davison, $15 per gallon. These shocks at some point have to affect all. The bond lift we saw Friday and into Monday, I'm going to call it a 48-hour structural price down, yield up, and presidential reaction. Is that what moved the president to make those statements?
Well, we'll have to see. I mean, is this a head fake for strategic reasons? Are they bringing troops in from Asia to initiate more of a ground operation? Or was yesterday's overture at about 7:10 in the morning a real off-ramp that indicates the beginning of the end of things? And of course, we do not know. The public probably knows about 20% of what's happening over there.
But in all your years, the bond vigilantes, I mean, Denny's right, they're for real.
Yeah, but if you look at the bond market too, Tom, credit spreads have widened. Investment grade 5-year CDS is about 15, 20 basis points wider month to date. If you look at high yield, 5-year high yield CDS is probably about 40 to 50 basis points wider. Haven't seen a major move.
The two of you got to help me here. I got a 4.95 30-year.
Yep.
And I'm watching the 10-year real yield is 2.02%. That was 180, 190. Everything, Paul Sweeney, everything's creeping up, right?
Lifted, absolutely. I mean, if you look at the warp function, the market's kind of pulled back on any rate cut here. What did you hear from the Fed last week? And do you think that's to what extent is it being impacted by what's going on in Iran?
I think it's interesting. I mean, clearly the Fed is in sort of a period of where there's a real predicament, right? They don't want to be accused of what they were accused of in 2021 into 22, which was they were late to the game. Inflation was rising. Headline went to 9.1%. They reacted late. There's a lot of criticism there. But I think when you look at the source of this inflation pressure and the duration of it, which is energy and supply, I think the Fed is being prudent, remaining on hold here. And in fact, I would argue that if the duration of this is shorter, and perhaps even if it's longer, if growth is impacted negatively, the Fed's going to be more willing to cut than to raise rates going forward.
Aaron Kennon with us. We continue with Clear Harbor Asset Management this morning on fixed income. I'm going to suggest for equity participants, right now is a good time to watch all the movements within the bond market. I rarely do this. It's just, it's like a bunch of numbers, but right now it matters. 3.88% in the 2-year. Paul Sweeney noted 4% even on the 2-year. A cup of coffee. We're creeping up by 3 basis points. A 4.37 on the 10-year, and the 30-year bond. I'm sorry, 4.95%, close to 5% yield. 4.95% as well. Paul Sweeney with Aaron Kennon.
We kind of lose track of some of these other news items in the marketplace. One of them is it's an election year, and historically, that introduces a whole level of volatility to the markets outside of some core fundamentals like earnings and interest rates and so on and so forth. How do you guys position for that kind of volatility, or do you try to look past it, I guess?
We do try to look beyond it. We do ask ourselves, how about the fiscal sort of momentum coming into an election year with the big, beautiful bill prior to this war? We were sort of constructive, right? You had the impetus for consumers to consume more with potential for paychecks coming in. You had no tax on tips, no tax on overtime. You had the ability to deduct your expenditures at the corporate level by 100% in year one. That was going to accelerate a lot of economic activity. That is accelerating a lot of economic activity. We are very constructive on that theme, but it's being obviously the crosswind of this moment is problematic.
I look at the makeup here of equity listening to the bond market. You say spreads have backed up. What if this continues? This fragility continues. I'm going to be up $3 on Brent crude here in a moment. I mean, what's the history here of what happens to equity markets when spreads widen?
Well, I mean, clearly there's a correlation. If we see high yield spreads, move in a pronounced way upward, that probably means that volatility index has spiked and equities are lower. And when vol spikes, we know what investors and hedge fund managers and some institutions do. They reduce their risk, they reduce their exposure. And so that's what we would anticipate. If this is a longer duration occurrence in Iran, and not, something that's just going to settle down over the next, let's call it 2 to 4 weeks, we would anticipate the VIX to probably shoot up well above 30, and then you would have risk-taking come off. We haven't seen the VIX above 30 month to date, which is sort of interesting. Almost, but not quite.